A very good evening, guys. After completing FA, now we get into the new subject which you all are going to study for the first time, that is financial management, which we call it as FM. FM you all have in this semester, and then straight away you all have in TY in both the semester, that is semester 5 and 6. Also in SY you all have a bit of this, but the name of the subject given is not FM, it is management accounting. Earlier in the BAF course, FM was just there in FI, it was not there in SY and TY. So there was a lot of criticism that what is the use of giving the name of the course as BAF when there is no finance. So 4 years back they introduced FM in both the sense of TY also. Okay, now see, before I start today, I'm straight away starting with the practical chapter, but before that I'll just give you the meaning of the word financial management. You all have done financial accounting, correct? FYJC mein, SYJC mein, you all have done bookkeeping and accountancy. In this sem, what we did till now was financial accounting. Now FYJC, SYJC ka bookkeeping and accounting is nothing but financial accounting only. Now what we do in financial accounting is, when you do the transaction, as soon as you are done with the transaction, you immediately record it. You buy goods, you record it as purchase. You sell goods, you record it as sales. You receive money, you record it as a receipt. You pay money, you record it as a payment. You pay for expenses, you record it as an expense. So that is financial accounting. Now here, financial management mein, there is nothing of accounts. You have to manage, as the name suggests. Now financial management is what? You are doing a business. Say for example, you are starting a business with 20 lakh rupees. So how you will manage that 20 lakhs, that is financial management. How you will take care of the finance what you have got, the money which you have got, how efficiently, how effectively you use that 20 lakhs, that is financial management. So in short, it is managing your finance, and finance is nothing but, in simple words, money. So financial accounting was recording of transaction, financial management is managing, and on that basis you have to take important decisions, because when you have to manage, you have to take important decisions. That means, suppose now say I need 20 lakhs. So from how you will get that 20 lakhs? Either you bring your own personal money or you borrow it from somebody. After getting that 20 lakhs, how much do I invest in my fixed assets? How much do I invest in my stocks? All those important decisions are a part of financial management. So financial management is nothing but how effectively you use your financial resources. The money which you have, how effectively you use in such a way that the funds are utilized properly without keeping it idle. Now you all have a special theory chapter. I'll do that later on, because right now we will focus on practical, as a few of you all have exams starting. So theory is fine, MC, but then solving the sums is more important. So I'll come back to that theory after a few days. Okay? So after knowing the basic meaning of the word financial management, let's get into the practical part. Now I had mentioned earlier to few of you all who had come here, you all have 3 practical chapters in financial management. One is leverages, which I am starting today. Second is cost of capital, and the third is time value of money. 3 practical chapters: leverages, time value of money, and cost of capital. Even in costing you have 3 practical chapters. Your FM and costing ka syllabus for FY, especially this sem, is very limited. Okay, now we get into the first practical chapter, as I told you, leverages. Okay, understand the meaning very carefully, and I am explaining you the concept. I will discuss the format with you. There are 3 formulas starting में. I'll explain you logically the 3 formulas. Then I'll be dictating 2 small questions so that we get the base today. Then tomorrow the sheets what I have given you, we will take the questions from the sheet. Okay? Now, the name of the chapter is leverages. It's got connection with the meaning of the word of the chapter itself, financial management. What I told you, financial management में you take a call how you manage your finance. Same thing is leverages. Leverages means the funds which you have, how effectively you have used that fund, that is leverage. Leverage means how efficiently you have used your money. The meaning is got somewhat connection, direct connection with the name of the subject itself. So leverages means how effectively you use your money. Okay? Now if you see that, keep that first page in front of you. Introduction part. See the second paragraph of 2 lines. You can make out from those 2 lines only. Just see that. Leverage implies the ability of a firm to use the fixed cost assets or funds in order to magnify the return to the shareholders. Shareholders, you all know. You all must have done in FYJC, OCSP. When you form a company, owners are the shareholders. Now what you all are going to do mostly in BAF and in this subject FM is mostly related to companies only. So what happens when you do business as a company, you do it for the benefit of the shareholders. So the more effectively you use the money, the better it is for the owners. The owners are the shareholders. It's very simple. As a common man, if you do a small business, if you do it very effectively, you reduce your costs, you will only make profits. No? The reduction in cost is as good as profits. So the more effectively you manage, the better for the owner. Reduction in cost means high profits. So in case of company, high profits means shareholders will get benefited. So leverages means how effectively you use the funds which have been allocated to you. Now as I told you, here there are few formulas, but before getting into the formulas, you have to understand the concept of an income statement. Income statement is nothing but your profit and loss. Income statement is profit and loss. Profit and loss you convert into a vertical format. Profit and loss you convert into a vertical format. That is your income statement. Okay. Now understand this statement logically. I am going very slow with this. Once you get the concept now, the chapter will become very simple for you. In this batch, you all have only MCQs. So end K high level sums are not expected. So focus on this basic. Okay? You all can write this. Give the heading income statement. Give the heading income statement. Below you can give 2 subheadings, particulars and amount. You can give the heading particulars and amount. Understand this income statement ka concept very. No need to draw columns, you can just give it simple headings. No need to draw columns. Okay. Now listen. How does a business start? From where you get major revenue? How business gets money? From selling the goods. So when you sell the goods, it is called what? Sales. Okay? So you always start with sales. So right there, sales. I am putting cross because this is a pro forma. When we do the actual sum, that time the figures will come. Okay? We start with sales. Now, after sales, now listen, what you have to deduct. Now when I say in business, you all have got this in detail in TY, but right now understand from this point of view. When I say cost, what do you mean by cost? You all have done in FA, capital revenue. It is an expense. Expense incurred is called as cost. Now basically there are 2 types of cost. 2 types of cost. One type of classification is based on this: variable cost and fixed cost. Variable cost and fixed cost. Understand the difference between the 2. Variable cost is that cost which varies or changes according to the output. Variable cost is that cost which changes or varies according to the output. The more your transactions, the more your variable cost. lesser your business transactions, lesser your variable cost. Variable cost is that cost which changes according to the level of production or output. More the production, more the variable cost. Lesser the production, lesser the variable cost. I'll give you an example. Say for example, you are manufacturing in your business calculators. One worker ko you give 50 rupees per calculator. If one worker manufactures a calculator, you pay him 50 rupees. So one calculator ka 50. If he manufactures 10 calculators, what you will do? 10 into 50, that is 500. If he manufactures 20 into 50, 1000. If he manufactures 30 into 50. If he manufactures 1000 into 30. So higher the calculators, higher his wages. Suppose from 1000 he comes to 500. So you will pay him only for 500. So whatever the worker manufactures, you pay according to the quantity manufactured by him. That is variable cost. Now you all are here with me. When you all came for the first time in the first class, to every student, I gave one folder. Per subject, I gave one notebook. So what I do? 5 students, 5 notebooks. 10 students, 10 notebooks. 20 students, 20 notebooks. Variable cost. 5 students, 5 folders, 5 scales. 10 students, 10 folders, 10 rulers. So according to the number of students I gave, so that is my variable cost. So variable cost is that cost which varies or changes according to the output. Okay? So I'll go step by step. From your sales, you deduct variable cost. From your sales, you deduct variable cost. Okay? Sales minus variable cost, the difference what you get, that is called as contribution. Sales minus variable cost, the difference what you get, that is called as contribution. Contribution is nothing but the difference between sales and variable cost. It is the excess over the variable cost. Okay? In short, the difference between sales and variable cost. What I told you, variable cost. The other one is fixed cost. Now what do you mean by fixed cost? What was variable? Again I'll repeat. Variable was that which varies or changes according to the level of output. Higher your production, higher the variable cost. Lower your production, lower the variable cost. Fixed cost mein what will happen? It will remain fixed irrespective of the level of output. Fixed cost is fixed irrespective whether you produce more or less. Now say for example, you have taken a factory on rent. Let's take the same example. You are manufacturing calculator. You have taken a factory on rent. Per month, say you are paying 20,000 rupees rent. Every month you have to pay 20,000 rent. You pay the rent to the landlord. Now landlord is not bothered. You manufacture 1,000 calculators, you manufacture 10,000 calculators, you manufacture 1 lakh calculator, or you sleep in the factory. Doesn't make a difference. He is bothered with the rent. So what will happen? Whether I manufacture or no, whether I manufacture less or manufacture more, doesn't make a difference. Rent I have to pay. So that is my fixed cost. It has got nothing to do with the level of output. Now this classroom, it doesn't belong to me. I don't own it. It is a rented premises. Every month I pay rent. Now whether I have 5 students, whether I have 50 students, whether I have 100 students or I have 20 students, I have to pay the landlord the rent every month. Irrespective of students being less or more, I have to pay rent. So that is my fixed cost. Variable, what I told you in my case, number of students, according to that notebooks to be distributed. Number of students, according to that I give folders. According to that I give scale. AC is on. Now whether there is 1 student or whether there are 5 students, electricity will be consumed that only. Lesser students, cooling will be more, but my electricity consumption will be more or less that. So all these are part of fixed cost. So fixed cost is that cost which has got nothing to do with the production or level of output. So 2 main costs, variable cost, which varies or changes according to your production, and the next is fixed cost, which remains fixed irrespective of level of. Okay? So now what I do, from this contribution, I will deduct fixed cost. From this contribution, I will deduct fixed cost. Okay? So contribution minus fixed cost, this what I get will be my earnings before interest and tax. This what I get is earning before interest and tax. You can also call it as profit before interest and tax. Earnings before interest and tax, or you can also call it as profit before interest and tax. Okay, clear with this, guys? So sales less variable cost gives you contribution. Contribution less fixed cost gives you earnings before interest and tax. Now what is the word used? Earnings before interest and tax. Now tax here means income tax, and interest means when you borrow loans. When you borrow money from somebody, on that you have to pay interest, so that is your interest cost. So now from this EBIT, we call it as, we will deduct interest. From your earning before tax, we will deduct interest, and after deducting interest, what you get, that will be your earnings before tax. After deducting interest, what you get, that will be your earnings before tax. When I say earning before tax, that means profit before income tax. Now you all know what is income tax? Income tax is a tax which you pay on the income what you earn. Now say for example, if the tax rate is 20%, if this amount is 1 lakh, I will pay 1 lakh at 20%. If this amount is 50,000, I will pay 50,000 at 20%. So whatever is your earnings before tax, on that you calculate the percentage of income tax. So what we will do, from this we will deduct income tax. From this we will deduct income tax, and after deducting income tax, the answer what you get will be your earnings after tax. Of course, for leverage I need only before tax, but then to we will explain earnings before tax. Clear with this? Okay, so I'll repeat. See, why I'm doing this in detail, because the formulas which you have to apply, there are 3 main formulas. Everything is based on this format. Logic comes from here only. So I'll repeat. Sales less variable cost gives you contribution. From the contribution, deduct fixed cost. That gives you earnings before interest and tax. From that, deduct interest. That gives you earnings before tax. From that, deduct income tax. That gives you earnings after tax. Okay? So this is the way you will do. And when you apply the formula of leverages, it comes from the items which are given here. What are the formulas? That will now. Okay? Now, what is the name of the chapter? Leverages. Okay? Now, when I say leverages, leverages are of 3 types. Leverages are of 3 types. These 3 are the main formulas also. First, understand what are the name of the leverages. Important for objective also with formulas. First, leverage is operating leverage. First is operating. Second is financial leverage. And the third is combined leverage. First is operating. Second is financial. And the third is combined. Combined means combination of operating and financial. Combined means combination of operating and financial. Okay? Now listen. Before I explain you all, let's take one by one. I'll put the formulas, and in the formula I'll explain you what is the logic of the three. Okay? Now I take first, that is operating leverage. That is operating leverage. Okay? Now see, operating leverage का formula. Right? Operating leverage is equal to, it is contribution upon EBIT, or you can write in full, contribution upon earnings before interest and tax, that is EBIT. You can also write contribution upon EBIT. Okay? Just take the picture. Contribution upon EBIT. Now listen very carefully. Contribution upon EBIT. See the logic now. Where is contribution? Here. Numerator is contribution. Where is EBIT? Here. Correct? Contribution and EBIT. Now see the logic. Very few people will explain you this logically. Numerator is contribution, denominator is EBIT. What is in between? What is in between? Fixed cost. So this means, so operating leverage indicates how effectively you have used your fixed cost. What I told you, leverage, how effectively you use your funds. Operating leverage shows how effectively you have used your fixed cost. So contribution upon EBIT, in between there is fixed cost. So the more better you use your fixed cost, higher will be the leverage. Got it? So that is my operating leverage. Okay? So the formula write down, it is contribution upon EBIT. Second, financial leverage. Second, financial leverage. Formula. Financial leverage is equal to, it will be earnings before interest and tax, that is EBIT, upon earnings before tax. It will be EBIT upon earnings before tax. Okay? Now listen, again see the logic. EBIT upon EBT. Where is EBIT? Here. Where is EBT? Here. What is between EBIT and EBT? Interest. So financial leverage indicates how effectively you have used your funds which you have borrowed. Because where I will pay interest? I will pay interest on the funds what I have borrowed. So this leverage indicates how effectively I have used my loan funds, the money which I have borrowed. Operating was what? How effectively I use my fixed cost. Finance is what? How effectively I use my borrowed funds on which I have paid interest. Clear? That's the logic. And now the third and the last one, we call it as combined leverage. We call it as combined leverage. Now listen, there are two ways in which you can show combined leverage. I'll show you both the ways. First, see, operating was contribution upon EBIT. Finance was EBIT upon EBT. Combined will be contribution upon EBT. Contribution upon EBT. Now see the logic. What I told you starting में, combine is what? Combine means combination of operating and finance. Now see the logic. Contribution upon EBT. Where is contribution? Here. Where is EBT? Here. In between what is there? Fixed cost and interest. Operating showed how effectively we use fixed cost. Finance showed how effectively we use the interest bearing funds. So combine is nothing but the total of the two. How effectively we use our fixed costs as well as the money which we borrowed. So that is the logic. It is a combination of operating and finance leverage. Operating only fixed cost, finance only interest, combine fixed cost plus interest. Another way of writing the formula is, I'll show another way. और करके combined leverage is equal to, now understand this, what is operating? Contribution upon EBIT, okay? And finance is EBIT upon EBT. So it is also called as operating leverage multiplied by financial leverage. Another formula is operating leverage into finance. Now see the logic. What is operating the formula? Contribution upon EBIT. Na? I'm using another pen. Operating is contribution upon EBIT. Now see the logic. See how interesting it is. What is finance? EBIT upon EBT. Correct? Combine is operating into finance. Now cross check. EBIT numerator denominator. Can I say EBIT gets cancelled? What remains? Contribution upon. So contribution upon EBT. This is another way. So you can apply this formula, and in case you have both the leverages, you can apply this. Whichever way you do, it is fine. Bolo. Clear with this? Got it? So this is the way you have to do. So sales less variable cost contribution, from that deduct fixed cost, get EBIT, deduct interest, get EBT. This part we don't need for leverages, later on we'll need towards the middle of the chapter, but starting may not. Deduct tax, you get earning after tax. Three leverages: operating, financial, combined. Operating contribution upon EBIT, financial EBIT upon EBT, and combined will be contribution upon EBT. Got it, guys? Okay? Now these three leverages ki basis pe I have given you all the question sheet, but in today's class we are not doing anything from the question sheet. I'll dictate two basic sums and we will find out all the three leverages in the sum. First sum I will do on your, or I will do with you all. Second sum I would like you all to try. Okay? I just pause the video, I just rub the board, I will be back in 2 minutes. Okay guys, back. Now see, the picture has come of the first question on the group. Okay? Let's see. From the following information, calculate operating, financial and combined leverage. Data is given: sales 20 lakhs, variable cost 10 lakhs, fixed cost 4 lakh, interest 2 lakhs. Direct information is given. Sometimes it will be given in terms of percentage. That slowly as and when we proceed in the chapter you will come to know. Okay? Now as I told you, before we calculate the leverages, first we need the income statement. Give the heading income statement. Okay? Same particulars and amount. Same particulars and amount. sales. What is the amount of sales given? 20 lakhs. Okay? So against sales, write 20 lakhs. Okay? Against sales, write 20 lakhs. Variable cost given 10 lakhs, as we discussed in the format, less variable cost, that is 10 lakhs. Okay? Sales 20 lakhs, variable cost 10 lakhs. Now what will be contribution? It will be the difference. It will be the difference between sales and variable cost. So sales less variable cost gives me contribution. Sales is 20 lakhs, variable cost is 10 lakhs. So 20 lakhs minus 10 lakhs, contribution is 10 lakhs. Next, fixed cost is given 4 lakhs. From my contribution, deduct 4 lakhs ka fixed cost. So 10 lakhs minus 4 lakhs, my EBIT becomes 6 lakhs. 10 lakhs minus 4 lakhs, my EBIT becomes 6 lakhs. From this, I will deduct interest. See the interest cost. How much it is? 2 lakhs. So 6 lakhs minus 2 lakhs ka interest, that gives me 4 lakhs. So 6 lakhs minus 2 lakhs, EBT is 4 lakhs. There is no information for tax, so I don't need the bottom part, because for leverages also I may do extra as I told it will be required later on, but right now for leverages we don't need. And there is no information for tax, so you cannot proceed also. Got it? Now we got these figures. On the basis of the figures from the income statement, we will calculate leverages. Okay? So let's take one by one. First, what is my first leverage? Operating leverage. Let's make it right. First is operating leverage. Okay? What is the formula of operating leverage? It is contribution bolo upon what?
EBIT.
Okay. Operating leverage is contribution upon EBIT. What's my contribution? 10 lakhs. My contribution is 10 lakhs upon my EBIT. How much is my EBIT? 6 lakhs. Now divide in the calci. 10 lakh divided by 6 lakhs. If the answer is in points, put it in 2 decimals. How much? 1.666 you are getting. So make it as 1.67. And what you all can do? You can write it like that. 1.67 is to 1. Even if you write only 1.67 is fine, but many professors prefer this. 1.67 is to 1. That means what? See here the logic. This means if my EBIT is 1 rupee, my contribution is 1.67 times of that. So operating leverage is this. That means 1.67 minus 1. 0.67 is my interest amount. How interest? Fixed cost. Contribution minus EBIT gives me fixed cost. So my contribution has come as 1.67. My EBIT is 1. So the difference 0.67 is fixed cost. That means what? My EBIT is 1 rupee and my contribution is 1.67. So I have earned 0.67 more than my EBIT to cover my fixed cost. That is the logic. I told you that how effectively you use your fixed cost, that is operating leverage. Okay? Therefore, my operating leverage is 1.6. Getting it? Okay? Next. Then later on there are sums with commenting, but now since this batch you all have MCQs, commenting part will not come, but that also I'll give you the brief at a later stage. Operating leverage, it will be EBIT upon EBT. Operating leverage will be EBIT upon EBT. Let's calculate. EBIT is 6 lakhs. EBT is 4 lakhs. 6 divided by 4. See? 1.5. So 1.5 is to 1. Now that means what? My EBIT is 50% more than EBT. 1.5 is to 1. Matlab 0.5 more. Check karo. 4 lakh ka 50% gives you 2 lakh. 4 lakh plus 2 lakh gives you 6 lakh. So the difference is 2 lakhs. That is the logic. Okay? Therefore, my financial leverage is 1.5 is to 1. Now next, combine. Now what we'll do? We'll do combine both the ways and check the answer has to be the same. First, let's go by the normal formula. What is combined leverage? It is contribution upon EBT. What's my contribution? 10 lakhs. What's my EBT?
4 lakh.
4 lakhs. Now check karo. 10 lakh divided by 4. 2.50 or 2.5 also you can say. 2.5 is to 1 or you can say 2.50. Therefore, my combined leverage is 2.5. Now what we'll do? Not required, but let's do it for few sums. We will do by alternate formula also. What is the alternate formula? I'll write a or karke. Or combined leverage is equal to operating leverage into financial leverage. So it will be 1.67 into 1.5. Actually, when you got 1.67, exact digit was 1.6666. So try doing that. Pura 1.666 into 5, you should get the same answer. 2.50. That we see. Same aaya na 2.5. What you have to do now? Exactly if you take now 1.666, you will get. Just try doing the calculation. 1.66666 till the end. 1.66666 till the end, multiply by 1.5, you will get exact. 2.49, that is 2.5.
Yeah.
Why? Because here the exact answer was 1.66666. We rounded off to 2 decimals, so because of that you will get some difference. Got it? This was not required because in case in MCQ sometimes what will happen? They will tell you to find out the combined leverage. They will not give you this, but they will give you operating and finance. So then in MCQs you have to attend this. Therefore I showed you both the ways. Got this? Clear? Now see the second question is there. You all try on your own. Okay? I'll just wind up the video. Those who are watching at home. Okay? The solution of the second question will come on to it. Okay? Take care.